Hello and welcome to Gravitas WINS Conversations. As I reach closer to 50, I'm thinking a lot about retirement. I have a bunch of questions regarding retirement and I have pulled in a lot more from my friends. I'm going to throw all of them at today's guest, my friend Rishi, who is a certified financial planner. Hope this conversation is useful to you as well. Let's start with this, Rishi. As a financial planner, how would you define retirement planning?
I think gone are the days when that old school thought comes that one should get retired at 60. So for having a retirement life or a retirement planning, so I think one should be financially free in your early 40s or early 50s, right? To get that financial freedom. So that's the basic definition of retirement planning for me. So in our profession, we got usually got queries. Now youngsters they're planning for the retirement in their early 40s. Anybody wants to plan at the by the age of 45. It doesn't mean they don't want to work after 45, but they just want to have that lifestyle. They want to have that financial corpus available to meet their expenses for the rest of their life, maybe 30 years post retirement, 40 years post retirement, maybe more. So that's the ideal definition of retirement planning. One should be financially free in their early 40s or by, I think, max by early 50s.
Define financially free. What do you mean by financially free?
Financially free means I should be able to do whatever I want to. If I want to buy anything, I should be able to do that. That
Okay.
means financially free. Then only then I can enjoy my life. Not having debt doesn't solve any purpose. So no, not having any debt doesn't mean you have wealth as well, right? You won't be able to enjoy your life, right? So I think you should be able to enjoy your
Okay.
life. You want to travel the world, you should be able to travel the world. You want to buy anything, you should be able to do that. You want to cater for the higher education of your kids, so you should be able to do that. That's the financial free. That's the definition of financial freedom.
Now, when should people start planning for retirement?
It's very important to understand the most valuable asset while you're planning for retirement is the time. I'm repeating it again. Time is the most valuable asset when you're planning for your retirement. The more time you have, it will be easier to accomplish your financial goals, right? So thumb rule for the retirement is if you start early, you save more. So that is the you'll be able to enjoy the power of compounding with time as well, because power of compounding has a direct correlation with the time, not with the money, right? So it's better to start early.
Okay, related question to that. See, when my dad was 50 years, I was out of college. But I got married when I was 33 and I had kids when I was 37. And I'm 50 and my kids are like, 13 years and so on and so forth, right? So people are getting married later and having kids even later. So how should they think about retirement? How should they plan? Not only their retirement now, after 50, 55, they are going to have this kids education also in place. So how should they think about that? How should they plan for it?
See, Joseph. Even I got married at the age of 31.
Okay.
I got kids at the age of 37, right? So I have twin daughters. So what I've experienced, so anybody who is planning their marriage later or kids having even later, right? I've seen those guys are more focused towards their
Mm-hmm.
profession, right? So there is a greater possibility of having financial freedom
Mm-hmm.
in that
Mm-hmm.
life stage, because then you can save more, right? So your savings or retirement planning or any goal planning is directly correlated with your
Mm-hmm.
cash flows. The more you save, the more you earn. So early you save, there is a better scope of power of compounding, which I
Mm-hmm.
mentioned earlier as well. So there is a
Okay.
greater
So
scope, I
you
think.
talked about saving. There's a
Yeah,
lot of cash flow, and then you
yeah.
can save a lot. Now, what are the instruments that I can use for retirement? Is it FD? Can I just go with PF, or can I put a SAP on index fund? What are the devices I have?
See, Joseph, right set of asset allocation is required for any planning, right? When I say right set of asset allocation, so there is no thumb rule which suits
Hmm.
each and
Hmm.
everyone, right? So let's say if I'm planning to save my to start my retirement planning in early 20 in 20s, right? So let's assume I'm 27, I'm starting my career, I want to save for my retirement life, right? And I want to plan my retirement 20 years down the line, so that I should be financially free, right? So in early stages, I'll be able to take more
Mm.
volatile assets, let's say equity, like you said, SIP in index funds or SIP in actively managed funds, right? So that will be more
Mm-hmm.
advisable, right? So if I'm in 50s, let's say
Mm-hmm.
I'm 52, 8 years down the line I'm planning my retirement, in that case I won't be able to take that much
Mm-hmm.
aggressive call on
Mm-hmm.
my portfolio. In that case my portfolio should be less aggressive or more towards
Mm-hmm.
conservative side, right? So that kind of planning should be done as per your time horizon. So it's directly your risk tolerance has a direct correlation with your time horizon. So if you have more time, then you have a more risk tolerance in your portfolio. If you have less time, your portfolio should be
Okay,
conservative one.
that's good advice.
Yeah,
Uh, so
yeah,
you talked about financially free as the one that you should
yeah.
aspire to. Would you put some number to it, like this much corpus you should have, some number to it, or it's just that, like, I mean, your lifestyle determines whether you're financially free?
Again, whenever we are planning for retirement planning, right? The first thing comes to my mind, what kind of life I want post
Mm-hmm.
my retirement, right? So if I straight away throw a question to you, what kind of life you want post your retirement? So answer is everybody wants to enjoy not the
Yes.
same lifestyle,
Mm-hmm.
better lifestyle. Once I'm done with my professional career, right? So everybody wants to enjoy a better lifestyle. Everybody wants to travel. Everybody wants to do X, Y, Z things, right? Whatever he or she likes, right? So once I'm clear about that goal, what kind of lifestyle I am looking for post my retirement, what I want to do, right? Then I arrive at a calculation what kind of corpus I'll be requiring at the age of retirement. So let me give you as one simple example. Let's say my age is, let's say,
Okay.
35 as of now, and I want to plan my retirement 20 years down the line. Let's say I want to get retired at the age of 55, right? And today my expenses are to the tune of
Okay.
1 lakh a month, right? So 1 lakh a month won't be the same 1 lakh after 20 years. So there is a inflation which comes into picture, right? So 1 lakh expense today at 6% inflation, that will be amount to, I think, more than 3 lakhs at that point in time after 20 years. So after retirement, let's say I want to live for another 30 years. I want to plan for another 30 years post retirement, right? So I want to have a corpus of around 8 CR at the retirement age to live for another
Mm.
30 years, right? If my corpus generates a return of around 7% post retirement as well, right? So that's how we calculate how much corpus we require at the age of retirement. So that is the basic rule, taking inflation into account.
So you talked about that corpus, that how much should be there. Now, a
Yeah,
lot of Indian households traditionally they have invested in gold or real estate,
right,
some in FD, very little in
right,
stock market, equity, and everything, right?
correct, correct,
Now, how would you, like, this particular asset allocation, gold, real estate, mostly gold and real estate, very little in stock market investing? How would you assess this kind of asset allocation? Is that okay? Because real estate, if I have three houses and they are going to give me some kind of a rent returns every month,
right,
that's a safe bet
right,
that I have, right? Post
right,
retirement.
correct.
Yeah. So
Post
would
retirement,
you,
yeah,
let's say, for example, like, I'm 35, would you recommend
correct,
investing in real estate because it's going to give me monthly rent on an ongoing basis after retirement? Or would you say, hey, go ahead with stock market investing, stocks investing, so that there is a compounding comes into play, and then it compounds a lot, and then you can use that after retirement in some way? What do you think about it? What are your thoughts on that?
See, when we talk about investing into real estate and the gold and the other fixed income instruments like FDs, right? So let's take an example. Last 10 years FD returns are close to, let's say, average return is close to 7.5 or 8%, right? So if you talk about post-tax return in case of FDs, if you're into 30% tax bracket, then you must be earning, I think, you earned just
Hmm.
5.6% a year
Hmm.
post-tax returns, right? And inflation is to the tune of 7.5% last 10 years. So you're not just meeting the inflation. We should be targeting beating the inflation, but reality is in fixed income instruments we are not meeting the
Correct.
inflation. So our money is being
Hmm.
depreciated day by day. So that's the case of FD. Now, if you talk about gold, the returns are
Hmm.
again the same. last 10-year returns are close to 8% in terms for bullions or gold. Anybody investing into precious metals, especially gold, right? Real estate, I believe, especially in our country, real estate is booming only because of the parallel
Mm,
economy which works.
mm,
Everybody knows that, right? So it's a second. You need a big chunk of money
mm,
whenever you're planning for a real estate investment. Yeah, you can't invest 10,000 bucks a month and go for a real estate investment. It's not possible. The point which you're making, the rental income, right? If you analyze the data in metros or suburbs or the cities like Chandigarh or anywhere, rental yields in terms of in case of commercial properties are close to 3 to 4% a year. I'm talking about an optimistic scenario. In most of the cases, it's less than 2%, right? Again, in residential properties, rental yields are close to 2 to 3%, right? So, having a 2 to 3% rental yield plus a capital appreciation of let's say 7 to 8%, which amounts to 10% uh, total return on my portfolio, lands
mm,
nowhere, right? When I compare it with the Sensex returns, Sensex has delivered a return of around 16%
mm,
since inception. 100 rupees invested in 1979, 1 lakh rupees invested in 1979 when the Sensex was at 100. Right now, the valuation is around 5 crore
mm,
91 lakhs. It's multiplied by
mm,
600 times. I'm talking about the Sensex. I'm not talking about the
mm,
actively managed funds. They've delivered even superior returns as compared to the
mm,
index funds, right? So I think when I'm clear about
mhm,
my goal, when my goal is beyond 10 years, then it's a
mm.
long-term goal. So whenever you take example of 10 years, equities or equity mutual funds have delivered much, much superior return as compared to any other instruments like FD or real estate or any bullions.
Wonderful.
So
Now, there
yeah,
is, like, say, for example, now we are hit by COVID. There is a lot of uncertainties. Even during this uncertainty, is it better to invest in equities or to park it in safe instruments, especially when we are talking about long term returns? Okay, I'm not talking about I have my daughter's wedding coming in the next year, so what should I do? I'm not talking about that. I'm talking about retirement, long term, maybe 10 years, 15 years down the line. Is it still
right,
better to go
right.
for equity or any other instruments are good?
Right. See, always one should have a
Hmm.
balanced portfolio to take the advantage of the each and everything. Right. There is a different scenario. Right. Like you mentioned, COVID. When there was COVID, there was uncertainty in the markets. Right. So my belief is uncertainty or volatile times comes with an opportunity to
Mm.
create wealth. So somebody invested in during the COVID time when there was first lockdown. So our Sensex came back from 42,000. It came back to
Mm.
25,000 levels. So now we're trading. I think Sensex is at
Yes.
60,000 levels. So uncertain times give you the opportunities to invest more to create wealth. For that, you need to have
Mm.
liquidity, right? So one should plan their portfolio in such a manner that at volatile times you should be able to
Mm.
invest more. So that should be the ideal
Lovely.
strategy.
I concur to that. I also did the similar thing when it was down, and yeah, my portfolio is a lot better now because of all the returns that have come in. You are right. Yeah, yeah.
Wonderful.
Uh, some of my listeners are indie makers. They're creators. They put out content and then they earn out of it. Now, sometimes they get a lot of returns, a lot of money, but there are months they don't make anything at all. So it's a flexible or rather fluctuating revenue streams that they have. So there is no steady salary like most of the employees. How should they think about
Right.
retirement? How should they plan for it?
Right, Joseph. What I've experienced is investing is more about maintaining
Hmm.
discipline, right? So even if you don't have a steady stream of revenue, let's say you get money 2 times a year, right? You are in such a profession, right? There is no steady stream of revenue. Even then, you can maintain a discipline,
Yes. Okay.
right? So disciplined investing, whether investing 1 time a year or 2 times a year or 3 times a year or 5 times a year, right? But you should maintain that discipline for that longer time
Hmm.
horizon. That is
Hmm.
important.
So it's a
Yeah.
it's a discipline.
So I think one
Okay.
should be
Okay.
disciplined. Yeah. Yeah. It's a 99% it is discipline. 1% is the market returns. 99% is the discipline. Yeah. Trust, patience, and discipline. Those three words I always mention wherever I'm into any session. So we need to trust the markets, we need to trust the economy, we need to have patience as well. And the third, then the most important is the
Mm,
discipline. Discipline.
okay. So wonderful. Now, so let's say, for
Yeah.
example, I am retired. I have the corpus
Right.
that we talked about. How should I
Correct.
plan that my financial life after retirement?
After retirement, since if you have planned your retirement life well in time, right, and you have that kind of corpus which you require, which you required at the time of retirement, then start enjoying your life. Have systematic
So,
withdrawals.
so
Do whatever you want
how
to do
much
in
should
your
I
life.
withdraw?
Yeah.
Uh, should I withdraw everything from my stock portfolio? How much should I withdraw? Mm.
No, 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 no. There is an option of
Uh huh.
systematic withdrawal. So you should withdraw as per your
Mm.
needs,
Mm.
which you have planned, right? So as per your monthly expenses, you can make a request, systematic request, that this much money I want every month at this point in time, right? So systematic withdrawal
Okay.
option is there to cater
Okay.
to your needs. Yeah.
Now, would you say, like we talked about this earlier, like, I mean, after a certain point, your risk appetite goes down, so it is safer to park in some of the safer instruments. So then, would you
Correct.
kind of recommend post retirement some of that money which invested in the equity, should I shift it to FD or something like that, or it should continue to compound?
It should continue to compound. It should continue to compound. My assumption is I am going to live for at least 20 to 25 years post my
Mm-hmm,
retirement
mm-hmm,
life.
yeah.
Okay? I don't need that money for next
Mm-hmm,
25 years. So that time horizon is clear even post
mm,
retirement, right? What I am looking for is to maintain my lifestyle, monthly lifestyle, daily lifestyle, right? So for that, systematic withdrawal plan is there. So I think that portfolio should continue. That should
okay.
compound.
The other thing that
Yeah.
comes in as I age, one of the biggest chunk of my expense is going to be medicals.
Correct.
Again, from a retirement perspective, yes, I might have the corpus, I might have a house on my own, and so on and so forth. But how do I balance out this particular medicals along with this? Do you have any thoughts on that?
Yeah. Biggest risk to your wealth is your health. You rightly said. So, to cater for your medical expenses, one can have
Uh-huh.
medical insurance, right? Right amount of medical insurance is required, right? Having a 5 lakh insurance or 10 lakh insurance won't do anything. That won't solve the purpose, right? So, if God forbids anything happens today, anything serious happens to me right now, as of now, right? I'm going to a good hospital. So 50 lakh, 1 crore is
Mm.
a normal thing as on date, right? So if I'm planning my retirement 10 years down the line or 15 years down the line or 20 years down the line, so my medical expenses or my planning for the medical expenses should be such that should be able to meet that those expenses, right? So if you talk about inflation in medical
Yeah.
expenses, it's double digit, right? It's
Hmm.
not single digit, right? So it's better to have medical insurance, number one, right? Most of the companies offer lifelong insurance
Mm.
nowadays. If you take insurance in the early stages, so it will cater to your medical expenses even post retirement, right? Plus you can create your own corpus even after having medical
Hmm.
insurance. You can start a small SIP or a whatever you feel like. I want this much corpus as a backup plan for my medical needs, right? So you can start
Wow,
an SIP.
that's a good advice.
Yeah, yeah,
I
yeah,
didn't know about that lifelong medical insurance. That's a
yeah,
good advice. Okay,
yeah. Earlier, it was not there, but
okay.
now they've started.
I'll look out for that. That's good.
Yeah,
Now, in
yeah.
your experience, Rishi, what are the common mistakes that you have seen people make when it comes to retirement planning?
There are a lot many mistakes people when it comes to retirement planning or planning anything, right? Number one, we don't plan anything. That's the
Um,
biggest mistake.
mm,
We don't plan anything. We don't have any plan. Say retirement, say anything. Matlab, we don't have a plan. That's the biggest mistake we do. Number one. Number two, we don't start
mm,
early. We think there is a lot more time. Retirement planning means we should start thinking about retirement
50.
when I'm in late 40s, yeah, or in 50s, right? So these are the mistakes that generally people do while when it comes to retirement planning. I think starting early, maintaining discipline is the most important. Third mistake which people do is they don't the right set of asset
Mm,
allocation, right? So right set of allocation is required when you're planning for retirement. Most of the people, even nowadays, they're contributing maximum amount of money towards their PF, towards fixed income instruments, having RDs in their bank account. So right set of asset allocation is also required to plan for the retirement life, right? So, like I said, 1 lakh rupees invested in Sensex 43 years ago is close
Mm,
to 6 crores, right? Whereas 1 lakh invested in a fixed income instrument at the rate of 9% is
mm,
just 41 lakhs
mm.
as of now in 43 years. So, I think that mix is required, that asset allocation strategy is required for the right
Okay.
financial planning. That
Yeah.
it's
So
missing.
you talked about asset allocation quite often. Can you
Yeah,
give me a little more about? Can you talk to me about what is this asset allocation? How should it look like when I'm 30, when I'm starting my career and my
right,
planning?
right.
How should it look like when I'm 50? And how should that asset allocation look like? Can you talk to me about that?
Yeah. In my opinion, asset allocation has a direct correlation with time,
Mm-hmm.
number one, and your cash
Mm-hmm.
flows, right? So when I say cash flow, it's your revenue income basically, right? So let's say if I'm earning 10 lakhs a month, I'm just taking an example. I'm earning 10 lakhs a month, and my expenses are to the tune of 1 lakh a month, right? Then even I'm 50 or I'm 60, I can tolerate high
Mm-hmm.
degree of risk,
Mm-hmm.
and vice versa. If I'm earning 10,000 bucks a month, even I'm in 30s or in 60s or 70s, I won't be able to tolerate any risk, right? Now, correlation with time, if I'm in 30s, I can tolerate higher
Mm-hmm.
degree of risk. I can go for equities, index funds, actively managed funds, right? So, if I'm in 50s, having a steady stream of revenue, then I'll be little conservative. I would like to have a balanced portfolio. So, asset allocation has a direct correlation with your time and your
Mm.
cash flows.
Good. Rishi, thanks a lot for sharing all of this information. Now, where can people find you? How can they approach you? And how can they talk to you about these things?
So anybody contacting me, I think I'm 100% reachable. I'll definitely revert in a day or two as per my schedule. So we can fix up a meeting and we can have an online or Zoom meeting or whatever he or she likes. So
Wonderful.
I'm 100%
Yes,
reachable.
you are always
Yeah.
very generous with your time, generous with your advice, and you are always available and approachable. Thank you very much, Rishi, for that.
Thank you, Joseph. Thanks for
Okay.
having me here. It was a wonderful discussion. Yeah.
I hope you enjoyed the conversation. Please share what you liked in the conversation on social media and tag us. Have a life of wins.